Plug Power Inc. is currently trading at exactly $1.95 USD, down 0.0100 or roughly 0.51% for the day so far. If you are looking at your screen right now, perhaps glancing at the red and green ticks flashing across your Fidelity mobile app, or staring at the charts on your interactive broker's platform, you are looking at one of the most polarizing, frustrating, and potentially explosive setups in the entire energy sector. We need to have a very serious, very direct conversation about what is happening with Plug Power, because the narrative that brought you into this stock, the idea of a seamless, inevitable transition to a hydrogen future, is currently colliding violently with the reality of balance sheets, political shifts, and market psychology. The price action we are seeing today, hovering just under that psychological $2 mark, is not just noise. It is a distress signal. But for the contrarian, it might also be the kind of signal that precedes a massive shift in momentum. Most people look at a stock chart and see lines. We need to look at this and see the battleground between a company fighting for its survival and a market that has largely given up on it. Let's be honest about the expectation versus the reality here. The expectation, the story that has been sold to retail investors on nearly every investing site, from SoFi Invest to the chat rooms of Robinhood, is that Plug Power is the Tesla stock of hydrogen. The belief was that just as EVs disrupted the internal combustion engine, hydrogen fuel cells would inevitably replace batteries for heavy transport and industrial use. Investors expected a hockey stick growth curve. They expected that by late 2025, we would be talking about massive profitability. But the reality? The reality is that we are staring at a stock price of $1.95. The reality is that the company is still burning cash, albeit at a slower rate, and the hydrogen economy has proven to be far more capital-intensive and politically sensitive than anyone wanted to admit. When you look at the intraday movement today, that slide of 0.5% isn't just a random fluctuation, it represents exhaustion. It represents long-time holders, people who bought in at $10, $20, or even higher, looking at their Schwab Intelligent portfolios and wondering if it is time to finally cut the cord. But here is where we need to stop and look closer. If you simply accept the bearish reality that Plug is dead, you might be missing the nuance of what has happened in just the last few weeks of November 2025. There is a massive disconnect between the stock price and the internal restructuring of the company. We just received news that the longtime CEO, Andy Marsh, is transitioning out, handing the reins to Jose Luis Crisepo. This is not a small adjustment. This is a regime change. For years, the criticism of Plug was that it was great at selling stock, but terrible at selling profitable hydrogen. The management change signals that the board is finally listening to the institutional giants, the BlackRocks and Vanguards of the world, who have likely been demanding a pivot from growth at all costs to path to profitability. When you analyze the trading volume today, you'll notice it's relatively suppressed compared to the manic days of 2021. This is actually significant. It suggests that the weak hands have largely folded. The people left holding Plug Power on their Robinhood app or in their Fidelity IRA are the diehards. This creates a fascinating supply setup. If any positive catalyst hits, say a reinstatement of full activity regarding the Department of Energy loan guarantee, there is very little overhead supply from short-term flippers because they have already left the building. The stock is coiled, but it is coiled in a dark room, and nobody knows if the next person to walk in is bringing a flashlight or a sledgehammer. Let's talk about the specific financial mechanics that are weighing on the stock right now. You cannot understand the movement of Plug Power without understanding convertible senior notes. In November 2025, just days ago, Plug closed an offering of roughly $375 million in these notes. Now, if you are a casual observer using a basic investing site, you might see Plug raises $375 million and think, great, cash. But the market is smarter than that. Convertible notes are debt that can turn into stock. This means potential future dilution. It means that the company is effectively saying, we need cash now to pay off older, more expensive debt, and we are willing to potentially issue more shares later to get it. This is why the stock struggles to break out above $2. Every time it rallies, sophisticated algorithms on platforms like interactive brokers or institutional trading desks sell into the strength because they are pricing in that future dilution. It is a ceiling that the company built for itself. However, the reality side of our equation has a silver lining that the market is ignoring. The proceeds from this offering were used to pay down high-interest debt and removed restricted cash covenants. In plain English, they unchained their bank account. They bought themselves a runway. This isn't a company filing for Chapter 11 tomorrow. This is a company maneuvering to survive until the market turns. And speaking of the market turning, we have to address the elephant in the room, the data center pivot. You have heard about NVIDIA stock. You know the AI narrative. The entire world is running out of power for data centers. The expectation was that wind and solar would fill the gap. The reality is that wind and solar are intermittent. You cannot run a billion-dollar AI training cluster on power that cuts out when a cloud passes over. This is where Plug Power is trying to wedge itself in. They are positioning their hydrogen fuel cells as the ultimate backup and prime power solution for these hyperscalers. If, and it is a massive if, Plug announces a concrete, signed deal with a major hyperscaler, think Microsoft, Amazon, Google, to power a data center exclusively with hydrogen, that $1.95 price tag will look like a historical anomaly. That is the lottery ticket aspect of this trade that keeps the volume alive on retail platforms like SoFi Investing and Robinhood crypto accounts that dabble in high beta stocks. Now, I want you to pause for a second. I want you to look at your own portfolio. How much risk exposure do you actually have to the hydrogen sector? Is it zero? Is it too much? Comment below how many shares of Plug Power you currently hold, and more importantly, what is your average cost basis? Are you holding from the $30 highs, or are you bottom fishing here at $1.95? I want to see where the community stands because that sentiment is a better indicator of support levels than any technical chart I can draw. Let's pull back and look at the company itself for those who might be new to this ticker. What does Plug Power actually do? It's easy to get lost in the financial engineering, but at its core, Plug is trying to build an end-to-end green hydrogen ecosystem. They don't just make the fuel cells, the engines that turn hydrogen into electricity, they also make the electrolyzers, which are the machines that turn water and electricity into hydrogen. They are trying to be the gas station, the refinery, and the engine manufacturer all at once. They have massive plants in Georgia, Tennessee, and Louisiana. The Georgia plant specifically was a massive technical achievement, proving that they could produce liquid green hydrogen at scale. The problem has never been the technology. The technology works. The forklifts at Amazon and Walmart run on Plug Power cells. They work. The problem is the economics. It has historically cost Plug more money to make the hydrogen than they could sell it for. They were subsidizing their customers' fuel. The investment thesis relies entirely on that equation flipping, on the cost of renewable electricity falling and the efficiency of their electrolyzers rising until they are printing money instead of burning it. This brings us to the macroeconomic pressure cooker of late 2025. We are navigating a political landscape that is increasingly hostile to green subsidies. The Department of Energy's $1.66 billion loan guarantee was the golden ticket. It was the government co-signing Plug's mortgage. But with the political shifts and the freeze on DOE activities, that loan is currently in limbo. The market hates uncertainty more than it hates bad news. If the news was, the loan is canceled, the stock would crash and then find a bottom. But the news is we are pausing activities related to the loan, which is a slow, agonizing drip of uncertainty. This is why you see the stock chopping sideways. Institutions using Fidelity Wealth Management Services or analyzing the stock via interactive brokers terminals are not going to deploy massive capital into a maybe. They need a yes or a no. But consider the counter-argument, consider the global picture. While the U.S. waffles on hydrogen policy, Europe and Asia are accelerating. Plug Power has significant joint ventures abroad. They are not solely dependent on the U.S. grid. If the U.S. market stalls, their exposure to the European energy crisis, where hydrogen is seen as a national security asset, not just a green luxury, could be the lifeline that saves them. This is the global arbitrage opportunity. You are buying a U.S.-domiciled company that might end up making its real money in the EU or South Korea. Let's discuss the retail investor behavior we are seeing on platforms like Robinhood and SoFi. There is a phenomenon known as the sunk cost fallacy, but there is also capitulation,